Good afternoon, Primerica, and welcome to Horizon Investments webinar on Why Blend. My name's Eddie Rollins, and I'm your host for this afternoon, and I'm joined by John Bryant, Senior Portfolio Strategist here at Horizon, as well as a special guest, Stephen Street, the Eastern Consultant for Primerica. We know it's been a really busy summer for you guys. There's been two great trips, one to the Mohegan Sun and one to the Diplomat. And then when you throw in a whole lot of conversion, you guys have had a really busy summer. I hope that you know that you've actually crushed it when it came to the conversion. In fact, the numbers that we heard were over 95% of the clients have signed up to move. And that's just absolutely awesome. So congratulations to everyone on the call. I hope that this coming long weekend, Labor Day weekend, that you'll get a little chance to rest before you start to sprint for Hang 10 in Hawaii. We'll be in Hawaii. We hope that you're going to be in Hawaii, but that's not why you called in and are spending time with us this afternoon. I think more and really on how to blend Strategist on the new platform. And I think that's something that we from day one, when Lifetime was started way back in 2017, I think that's a message that we've carried. So I'll turn it over to John. John, all you.
Thank you so much, Eddie. Thank you, everyone, for being on here today. Again, my name is John Bryant. I'm a portfolio strategist with Horizon Investments. I'm a team member, part of our consulting group. And what our group does is we build custom portfolios and model portfolios together for our financial advisor clients. Today, we're going to explore the potential benefits of blending investment managers together and strategists together. And I'm going to give you guys a peek into what our team looks at when we evaluate strategies and how we actually build model portfolios. Before I go into anything into specific, I wanted to cover Horizon Investments, who we are and what our mission is. Our mission is to empower the advisor. The way we do that is by providing investment solutions that you can understand and trust. Throughout their life. So that's what goals-based is. But why do we believe in goals-based? I think a really good way to frame what goals-based is versus traditional investing is actually in the table here on the right. Financial plans are based on individuals, and we think investments should be as well. We think that when you're evaluating products and what you should be focusing on is actually delivering outcomes and reaching goals instead of selecting products just based on risk tolerance and just based on outperforming a benchmark that may actually not matter to your clients. And recurring and annual reviews should be based on changes to the financial plan and not just on what's happening in the markets. So what goals-based means in terms of our investment framework is we believe that each investor's journey can be divided into three distinct stages that we call gain, protect, and spend. Each of these stages have unique objectives and risks to mitigate. The gain stage is primarily for, think about your 30, 35, 40-year-old client who retirement is really not in the purview just yet. They are just trying to grow and build wealth. But then they eventually reach a point where maybe they're 5 to 7 years from retirement. That's where they may actually be in that protect stage, where we want to have a process for mitigating against catastrophic loss. And finally, when they do retire and they need to rely on their portfolio for income needs, they would be in the spend stage, and there are additional risks there too, which I'm going to get into throughout this deck. I wanted to stop here and just provide some understanding on what goals-based is in terms of how we build models, because I'm going to bring it back at the end, and I have portfolios that are set up for each of these stages: gain portfolios, protect portfolios, and spend portfolios that you guys can use to build on the platform. So why blend? Well, what are the potential benefits of diversification? I would just say when you guys enter into Finance 101, we all learn about the dangers of concentrated positions and holding too many eggs in one basket. But we all learn it from the standpoint of adding individual stocks helps reduce overall portfolio volatility until you get to about 30 or so stocks, and then you get to a point where you're basically just at average market risk. From there, it's where you add on other asset classes like fixed income or alternatives to even reduce portfolio volatility further. But what we're doing is, what if we're not blending stocks together, we're blending managers together? And that's what this may look like on the next page. The chart is an investment growth chart, and you'll notice what's highlighted is the blended allocation. What specifically this is a Morningstar category that represents the 50 to 70% equity category. So basically a composite of balanced funds. In addition, overlaid behind it is small cap stock performance, large cap stocks, core bonds, and short-term bonds as well. The point I want to make here is you can achieve the same risk reduction benefits of adding more stocks to a portfolio, but by relying on a blended allocation of managers. And while you may not see the high highs of small cap stocks, you are not going to experience the catastrophic lows as well. And if you actually participate in this tighter band, it will be a smoother ride for your clients, and it will allow them to continue to believe in and maintain their financial plan that you helped build. So when you're building model portfolios, what are the potential benefits there? I think this chart is a really good one to juxtapose, right? You could use single managers, which is going to be on the left, or a blended allocation of those managers. Let's say you have a go-to tactical equity manager, or a go-to strategic equity manager, or a dividend income manager. You may be using those as total client solutions for different clients, depending on what their goals are, right? You may have a client who just needs income. All right, let's put you in the dividend income manager. A client who needs growth, let's put you in the strategic equity manager. But before long, if you have a big enough book of business of families you're serving, you may actually have conflicting exposures across all of your clients and models, and may make for difficulty in terms of monitoring all of your clients' portfolios and appropriately benchmarking. Not to mention, it also could add time. It could add time to your preparation when you go into client reviews. If you're using too many one-off single managers, what we would recommend is actually having a blended allocation where you could use those same managers you know and love and believe in, but use them in a way that regardless of risk tolerance or stage of life that your clients are investing in, you can use it in a way where the exposures are consistent. There's potential for a more efficient process for portfolio monitoring. You're achieving diversification across managers. And not to mention, I think a really important part here is this is going to allow for a more scalable process for client reviews. It's going to give time back to you guys, where you can use that to either deeper engage with your clients or just continue building your book of business and your practice. This next table I wanted to cover because it's a really important one to evaluate. Let's say you have one client who's invested in manager 1, and another client invested in manager 2, and another client invested in manager 3, and finally you have the fourth client who's invested in an equal weight blend of those 3 managers. Same initial investment, you start with 100K. What happens after year 1? Well, manager 1 went up 25%. Shoot, I should have had everyone invested in manager 1. I'm going to sell out of manager 3. Year 2 happens. All of a sudden, manager 3 actually bounces back. Year 3 happens, and manager 1 suffers a pretty bad drawdown. What you'll notice is the final portfolio value, the actual portfolio value that yielded the most amount of money was the multi-manager blend, which was just an equal weight of all 3 of these managers. The point being is that this equal weight blend provided a smoother path for your clients and actually provided a better financial outcome by the end of this period too. The one thing I would add to this is it's going to be really difficult to try to time which manager is going to have the best year. Manager 1 had the best year in year 1, but it's going to be really difficult to then sell out of that and go into manager 3. We all know that timing the market is difficult. timing manager performance is going to be difficult as well. Like anything in life, there are going to be trade-offs. There are going to be pros and cons to any decision you make, and that includes building portfolios. So when you're looking at strategies, I think this is a good spectrum for you to kind of identify where does this strategy fit, right? Is this more of a passive buy and hold type strategy? Is this more active or tactical? Is this diversification away from risk assets, equities, and fixed income? At any point in the spectrum, there are going to be pros and cons. If you are a buy and hold type person and you want to just use a passive manager, the pro is going to be that it's going to be low turnover. There aren't going to be many changes to that. The con is that it's going to be inflexible. There aren't going to be many changes. If you want to use a strategic manager, generally that overweights maybe global allocations or value stocks or small cap stocks. That's actually going to be supported by longer term statistics. There's going to be investment reasons to hold those allocations, but the con is that no past performance is a guarantee of future effectiveness. The passive and strategic part are going to generally be for more accumulation type clients, and I would actually incorporate active as part of this too. The tactical opportunistic diversifier, this is where you're going to have more tracking error relative to benchmarks. They are going to be dynamic allocations. They may even hold alternatives where there may be potentials to offer additional downside protection, right, in the case of a diversifier. But the con could be, there could be a potential drag in strong bull markets or sharp recovery markets as well. So we think it's really important to know which strategy, where does this fit on this spectrum, and kind of how to blend them together in an appropriate way. Now, when you're looking at models and historical performance, I think we've all seen a similar chart. This is actually a Callan chart where the highest return over the past few years, you may have seen it in terms of calendar years, the best performing asset classes are at the top, the lowest performing asset classes are at the bottom. With a blended allocation, you're never going to be at the top. You're never going to be at the bottom either. There's always going to be something in the portfolio that you are apologizing for, right? In terms of what we saw in year 1 and 2, you may have been apologizing for manager 3 in year 1, but your clients would have been happy to hold manager 3 in year 2. I think it's the same way when you're viewing this. With a blended allocation, you're never going to have the highest return, but you're never going to have the lowest return. And I think with appropriate security selection, that you could live in that 25th to 40th percentile of stocks, a little bit better than average. And if you compound average performance over a longer period of time, your longer term trailing performance will be superior, will be above average. That's what we're trying to do here. So when you're blending, what are some characteristics to consider? Well, I think there are 3. Individual strategy performance is one thing. Are we actually achieving diversification? And are the strategies we're using, are they complementary of each other, or are they getting in the way? When we look at individual strategy performance, there are a lot of ways you could break this up. And actually, this is a sample of a heat map that our team uses when we evaluate strategies. We could look at a lot of different quantitative data. Return rank in the category, Sharpe ratio, so that would incorporate risk-adjusted returns, batting average, in other words, how often does it beat its benchmark, information ratio, up capture. We also look at quantitative metrics that relate to downside performance. This is important when we're building portfolios in that preservation and distribution stage. We don't want to just look at up capture. So specifically, we'll look at down capture rank, Sortino rank, which looks at volatility, but just downside volatility, max drawdown, and CalMAR rank. CalMAR is basically just your return over your max drawdown. When we're looking at this, what our team likes to do is evaluate single strategies relative to their category, right? If I'm looking at a large growth manager, how has my manager that I've selected for that portfolio done versus other growth managers available to me? It helps really determine rank in the universe and to determine whether I'm selecting a good one or not. Now, These are all quantitative data points. I will say we also look at qualitative measures as well. Qualitative could be having conversations with the portfolio managers, right? Learning more about the process, what actually goes into it. Also evaluating style drift over time. Style drift is really important, right? If you're using a passive manager for large growth exposure, you want to make sure over time that it continues to exhibit large growth exposure and not moving more into the core value camp. In addition, one other qualitative data point that our team looks at is manager tenure. If you've had a recent manager change to a strategy, that's pretty important. What's happening there? And I think it's a good time to reach out to the firm to learn a little bit more about the turnover and the process and what may or may not be changing, because there may be changing expectations. So performance is one thing, but also we want to achieve diversification. That's the whole point of what I just covered in a few slides ago. On the left, let's say you were blending a passive and a strategic manager together, but they both looked to be large blend, maybe a moderate large growth overweight, and they were all 100% US stocks. Even if you're using two different managers, are you really achieving diversification? It's almost as if you really shouldn't even be blending at all. So what I would say is, on the right, this is where you could look at, I'm going to use my go-to passive manager, my go-to strategic manager, but I may add in my active manager, which would be that light blue, to be tactical, to make changes based on what's happening in the market. I may add in even a diversifier to be uncorrelated against broad asset classes like equities and fixed income. Again, primarily, this is where, when we're adding in the opportunistic and diversifier, is going to be in that protection and distribution stage. But it's a really good example of, even if you're blending two different managers together, if they are invested in the same way, you may not be achieving that diversification you're hoping for. And what lastly would be complementary strategies. We want to build portfolios where the pieces all fit together cleanly. I would say, when you're learning about portfolio construction, you may encounter like negative correlation is a good thing. I don't 100% believe that, right? If you're building wealth, you want to have positive correlation to equity markets. If you have two assets that are perfectly negatively correlated, then you may not be getting anywhere, right? That's where they may be getting in the way of each other as you're trying to grow wealth. Versus having complementary strategies that actually fit neatly could provide better portfolio solutions for your clients. So I want to cover a few things. This is generally what I've talked about is the benefits of diversification, a little bit into goals-based, but I also want to cover a few examples of blending together that you guys can use on the platform. And certainly this is meant to be illustrative. If you have other managers you want to evaluate and how they may fit in with Horizon Investments, that's where you can reach out to us and we can have that conversation. Before I show you the actual pre-built model portfolios, I want to bring this back to goals-based. And I want to remind you guys that each of these stages along the investor journey are going to have primary objectives and associated risks there. For the accumulation client, their primary objective is growing wealth. What is their dominant risk? Well, it's really just volatilities. They just need equities, and if they can't handle the volatility of equities, that's where they would add fixed income. Well, eventually they are 60 years old and they're thinking about retiring in 5 years. They may be a good candidate for that preservation stage. That just may be where they're in that part of life. Their risk is not just volatility anymore. It's actually absolute loss. I can't suffer a 30% drawdown if I'm going to retire 5 years from now. Okay, let's build a portfolio that optimizes around and best mitigates against that absolute drawdown risk. But you'll notice that there are building blocks on top of each other. It's not like you can use money market as 100% allocation. Even if we know it likely won't draw down 30%, you may not get the growth that you might need even in this stage as well. The last stage is going to be that spend stage. This is where your clients are retired, taking income from their portfolios. The main risk here is basically outliving your income. You don't want to run out of money before you pass away. It's really, when we add time into this goals-based context, it changes how we need to build portfolios. You'll notice that, again, at no point in this stage does growing money not matter. That accumulation block is as part of this entire stage. But when you get to that preservation and distribution, we need to also have a process for mitigating against drawdown, catastrophic market loss. But it's that last stage that puts this all together. So when we're looking at blending in the accumulation stage, what are we trying to accomplish? Well, I would say we want to be able to provide your clients access to global markets. Horizon Investments is a global manager. We believe that if you expand your opportunity set to be one that includes US markets, Europe developed markets, and emerging markets, that over a full market cycle, the opportunity to improve risk-reward dynamics improves. We also want to consider both active and passive exposures. There may be opportunities for certain exposures or asset classes where passive vehicles are a perfectly good solution. And there may be other times where we want to actually rely on active managers to help make those decisions for us, especially when markets are moving so fast. Lastly, we also want to incorporate quantitative data and qualitative methodologies when we select strategies that go into our models, but also when we evaluate model performance. So as an example, we have 3 models built here, an aggressive model, a moderate model, and a conservative model. These models incorporate Horizon Investments, Invesco, and American funds. The aggressive model is going to be around, just to give you guys perspective, around an 85-15% equity exposure. The moderate model is going to be around a 60-40, and the conservative is going to be around a 40-60. You'll note that we are using only 3 managers in this stage, Horizon, Invesco, and American funds. But we have a variety of risk tolerances here. So we know that when you guys use a portfolio and there's a need for an aggressive risk tolerance, we can use those same managers. And versus another client who has a more conservative risk tolerance, we can use those same managers. We're just going to be relying on a little bit more fixed income. But we know that the exposures are going to be consistent across. I'd say if you were to evaluate how these managers fit, Horizon is going to be your active and tactical manager. We believe in actually having an active asset allocation process. Just to give you guys perspective, we've made a lot of changes this year even. Currently we're heavier tilted toward U.S. equities. We just believe in, over the short term, we believe in the power of U.S. domestic growth, but we still have allocations toward Europe developed and some emerging market exposure as well. Invesco and American funds are going to be more strategic managers. They are also going to have global allocations as well. But you'll notice, again, I think the important thing I want to highlight is that we have 3 pre-built model portfolios using the same managers, just a variety of different risk tolerances, so we know that the exposures are going to be consistent across any risk tolerance. For the preservation stage, not only are we trying to continue to grow wealth, but it's at this stage where we also need to plan and protect against downside risk. Specifically, I want to talk through what does downside risk mean and what exactly, in terms of numbers, are we trying to plan for, right? Because you could have a 10% drawdown from all-time highs. We're not really trying to protect against that. It's more the catastrophic market loss that we are trying to protect against. When you learn about and think about sequence of return risk, it's those catastrophic market losses that take longer to recover. And the problem is in this stage, your clients no longer have the luxury of time to recover. Whereas in the accumulation stage, longer time horizons allow you that opportunity. But because this time horizon is so compressed, we need to have a process for mitigating against catastrophic market loss. We also want to incorporate differentiated approaches to risk mitigation. I'll be honest that there's no one single strategy out there that's going to do great in every single market environment, whether that's an upward trending market environment, a downward trending market environment, or even one that's really choppy, where we are having drawdowns and subsequent recoveries really quickly. We also want to seek to improve investor discipline. We all learn about behavioral risks when it comes to investments, right? We want to avoid during market drawdowns the client emotional need to go to cash, because we know how disruptive that can be to financial plans and how quickly markets can potentially recover too. So when we're looking at pre-built models for the preservation stage, this is where we're going to incorporate our Horizon risk assist portfolios. In addition, we also have Sage tactical ETF portfolios that you guys can use as well. Let me cover a little bit about Horizon Risk Assist and what we're trying to accomplish in this stage. Horizon Risk Assist is an algorithm that is meant to be a participant in equity markets during good times, recoveries, and bull markets, but protect against catastrophic market loss. The way we do that is the default position is to be, in the case of Horizon with Risk Assist, 100% exposed to stocks. But when drawdowns start to happen and when drawdowns accelerate, we will de-risk the portfolio. So we'll take a little bit from equities into short-term fixed income as a way of protecting against the drawdown floor. But it's not just about protecting drawdown, right? Eventually, markets recover. We will also reinvest when there are gains in the portfolio to get back to our target allocation. This is a way of basically stepping in and out of the market without having to go 100% out and miss out on potential recoveries. Because like I mentioned, 10% drawdowns are not really what we're trying to protect against. They happen every other year. It's those drawdowns of 25, 30% plus that don't happen very often. But when they do, they can be pretty disastrous to financial plans. With Sage Tactical, I would say that the moderate growth target allocation is around a 60-40. The Sage Tactical ETF Moderate is around a 40-60. And the Sage Tactical Multi-Asset Income is around a 20-80 equity fixed income blend. So it's actually a pretty good blend when you think about it. So you could use a preservation growth model, which is 50% focus with Risk Assist and 50% Sage Tactical ETF Moderate Growth. You're going to get a target equity allocation of around, I would say it's going to be around 75% equities, but that's 75% now. Back in the fall of 2022, Horizon Focus was pretty heavily de-risked. We believe in having a dynamic asset allocation strategy to participate in strong economic recoveries and bull markets, but protect against bear markets when they happen. And lastly, for the distribution stage, what we're trying to accomplish here is providing access to global markets. Again, we want to consider both active and passive exposures. We want to have downside risk mitigation to address the risk of catastrophic drawdowns. Again, that sequence of return risk that we all know and fear, it doesn't go away when you retire. In fact, it's ever present throughout that stage. Lastly, another way to think about this is we need to have a liquidity reserve that can be drawn on for distribution. So this is where we're going to be incorporating our real spend portfolios. And another manager you could consider for this stage is Franklin Templeton Income. I'm going to explain why I think this is pretty complementary. But we have three models in the distribution stage: growth, moderate, and conservative. Growth is going to incorporate a 50% allocation to Horizon Investments Real Spend 6. The moderate portfolio is going to use Real Spend 5. And the conservative portfolio is going to use Real Spend 4. And it's an equal weight blend of around 50% to Horizon, 50% to Franklin Templeton Income. You'll notice the 654 as it relates to real spend. These actually represents target withdrawal rates. So the way I like to think about it in the distribution stage, it's really no longer about risk tolerance anymore. You could be a conservative investor in the accumulation. You could be a conservative investor in the preservation stage. But if you enter the distribution stage and you tell me you need 6% of your portfolio, I wouldn't say you're conservative anymore. You might need to have a decent amount of equity exposure. Why is that? It's because life expectancies are long. This distribution stage could be 20, 25, even 30 plus years. If you're holding a heavy bond allocation that entire time, that may actually present risks in terms of meeting that withdrawal need sustainably. So our real spend portfolio allocations are optimized to meet that target spend need. We also have a liquidity reserve that represents around 3 years of living expenses held in that portfolio. And specifically, we actually look at short-term treasuries when we are looking at that liquidity reserve, which, it's for as bad as the rate cycle has been, it's kind of nice to get a decent amount of yield on money markets and short-term yields as well. When we're blending it with Franklin Templeton Income, this is going to be a heavy income focused portfolio. It's going to be a mix of equities and bonds. Generally, over the long term, it's going to be about, I would argue, 30% equities, maybe about 65 to 70% fixed income. Within equities, they are going to be placing more emphasis on cyclical sectors that are going to be dividend paying. So you're going to have higher allocations to financials, materials, energy, industrials. On the fixed income side, you're going to have allocations to high yield bonds, investment grade bonds, treasuries to some extent. In addition, they also use preferred stock and convertibles to drive yields. They basically use a value-oriented approach to drive those sustainable yields. And I think it's a good complement because our Horizon real spend portfolios, if you think about it relative to a target date allocation, they're going to be pretty structurally underweight bonds, whereas Franklin Templeton Income is going to actually be much heavier into bonds to drive that yield more consistently and sustainably. The last thing I'd say, guys, is these are allocations. We're going to show you, Stephen's going to show you how to build these models, and certainly it's meant to be illustrative. If you have go-to strategic managers, talk to us. We can help you build out a process for how Horizon may fit in with that manager. What are some risks you need to evaluate? What are some expectations? So this is a really good way to start thinking about this.
So John, just a quick question. So we've shown, I think, some really good education on why blend and why blending makes sense. But I'd ask, gosh, there's 13, 14, 15 managers or strategists on the platform. How do you learn so many? Or do you really try to focus on 3 to 4 weeks and learn those stories that blend well together?
Yeah, I think you know and like and are familiar with. Make sure you understand them, and also make sure you know where they fit on that spectrum of that trade-off, right? Are they more strategic? Are they passive? Are they diversifiers? Are they active, right? It's going to be better if you can deeply know the strategies you use versus others on the platform. There may be plenty more on the platform that take into consideration. But I would say rely on our team to help you narrow down those choices. There's a lot of options there.
So thanks for that. Thanks very much, John. And we are live for questions. And while you guys kind of think through any questions, what I'd love to do is turn it over to our friend Stephen, and let him back at Mohegan Sun over a couple lunches and dinners that I had conversations with many of you, and there were some I don't know if confusion or just training or however you want to couch that, but we thought it would be great to add Stephen to today to show you how to do that. So Stephen, all you. Thank you.
Yeah, thank you, Eddie. Thank you, John. And as I'm sharing my screen here, I think these guys, they put it in really great perspective. So we kind of talk about it on our team as well. You don't have to go out and learn all 12 of our asset managers. Treat it kind of like your retail business. There's probably one or two mutual fund companies that you're out there using the majority of the time. Knowing 3 or 4 of these guys, it's only 3 or 4 stories that you have to know and recognize and follow up with throughout the year. So let's make sure that my screen is showing first so I can get into just the basics of the proposal system. So I'm not going to go do a deep dive of our entire proposal, but I do want to show the investment selection page for 2 different reasons. One, when you go in, and in this case, for this investor, by the way, we've gone with a conservative growth profile. And when you're going in and you're making that investment selection, it's real simple if you're trying to find one manager. When you hit the select button, it'll pop up. Let's hope it pops up with the page that we need to actually choose that manager. So just give it 1 second for it to load here. And so what you're going to find is after you see some of these filtering options at a conservative growth and risk profile, if I wanted to go in and I wanted to find any of Horizon's models that fit that category, you'll see they're listed right here. So whether you've got the conservative portfolio or one of the real spend models, the 4 and the 5. One question I do get, quite often is, well, where do I find the real spend 6? That will be in your moderate growth risk profile just from our categories and where we have it. So again, if I want to go in, and it's real simple to select a model, right? So this is part of the proposal. You do one of these proposals for every application that you submit. If I want to go in and I want to choose a spend strategy, say the real spend 5, I would just go in and make that model selection. And it's really that simple. But then again, I like, what John brought to the presentation today, right? Talking about blending managers. So in another scenario that I've brought down here is just one that he mentioned. I did it while these guys were talking. You see here that we have a blend of Horizon, Invesco, and American funds. So this really is just going to illustrate the capability and the flexibility that you have within the new platform, where I can go in and I can dial up and dial down the percentages any way that I see fit for the client and for my book of business. So again, just to illustrate, this is the Horizon, conservative portfolio where we used 40%. We had another 40% to Invesco, and we put 20% in that American funds conservative growth. So that's really it. Just I didn't want to take too much time. I really do appreciate, being from home office, able to speak on the Horizon call. These guys have been, great partners for us, exceptional support from their sales team. So again, I really appreciate it, guys. And if I could just say one last thing, if you're tuning in on this call, make sure that you tune in on all of our trainings that we have on this platform. We know that it's a steeper learning curve with the new technology. So we do offer trainings. It's every day, 4 p.m. to 5 p.m. Monday through Thursday, and then on Fridays at 2 p.m. to 3 p.m. And all we do is go over the proposal, the application process, servicing your clients. So, doing those withdrawals, setting up purchases or systematic purchase plans. So everything in between, and it gives you time to ask and answer questions. So Eddie, John, I'll toss it back to you, but thank you again.
Thank you, Stephen. That looked fairly easy to do. Is that right?
Pretty simple. You log in, you answer the questions for your risk tolerance, and once you put in that dollar amount for your investment, you go in and you make the model selection. That's it.
Great. Thank you so much for being a part of this. We are below the hour of 5, which is what we intended to do. Let me just say thank you again. We certainly, since 2017, have appreciated the relationship that we've had with Primerica. We know that you guys, I still tell the story of Bill Kelly coming into our office to do due diligence, and some of the things he told me And all I could say is that if I made a bet every time that I got that same type of advice from him, then things would work out really well. And it has for Horizon. Hopefully it has for you guys. Certainly enjoy your Labor Day weekend and hang 10 for Hawaii. We look forward to seeing you in Hawaii in February. Thank you so much.